Here is something that almost nobody tells you when you first start learning about the stock market. On any given day, the numbers you see flashing across a screen, prices rising, prices falling, fortunes being made or erased in a matter of hours, those numbers are not just math. They are not the cold, logical output of spreadsheets and economic models. They are, at their deepest level, a reflection of something far more unpredictable than any formula. They are a reflection of human emotion, of fear, of greed, of hope, of panic. And the moment you understand that, the stock market will never look the same to you again. Welcome to Financial Psychology. Today, we're going to take you behind the curtain of one of the most powerful and misunderstood systems ever created by human civilization. We're going to explain how the stock market actually works, why it moves the way it does, and why the single most important variable in any investment equation is not a number at all. It is the human mind. Stay with us until the end because the final section of this video might completely change how you think about your own financial future. Now, let's dive into where the story of the stock market truly begins. To understand where we are today, we need to travel back roughly 400 years. Imagine you're a merchant in Amsterdam, sometime in the early 1600s. You have heard extraordinary stories about the spice islands of Asia, cinnamon, pepper, and nutmeg, so valuable that a single successful voyage could make a man fabulously wealthy for the rest of his life. But there's a problem. Sending a ship to Asia is almost impossibly expensive. It requires building a massive vessel, hiring a crew, stocking provisions for a multi-year journey, and hoping that the ship does not sink in a storm, get attacked by pirates, or return to find that prices have collapsed back home. No single merchant could afford to absorb that kind of risk alone. So they did something revolutionary. They pooled their money together. Multiple investors each contributed a portion of the funds needed to finance the voyage. And in return for their contribution, each investor received a share, a small ownership stake in the venture. If the ship returned loaded with spices, everyone who had invested would receive a portion of the profits proportional to how much they had put in. If the ship sank, everyone shared the loss. The risk was distributed, the reward was distributed. And with that simple but brilliant idea, the joint stock company was born. The Dutch East India Company, founded in 1602, formalized this concept on a scale that had never been attempted before. It became the first company in history to issue shares to the general public, and it created the world's first official stock exchange in Amsterdam, where those shares could be bought and sold among investors. Think about that for a moment. The fundamental architecture of the global financial system you interact with today, whether you realize it or not, was laid down by spice traders in the Netherlands over 4 centuries ago. The stock market is not some abstract modern invention. It is a very human solution to a very human problem. How do we share risk and reward across a community of people who want to build something bigger than any one of them could build alone? Now let's look at what a share actually is and why companies need investors like you. Fast forward to today, and the principle is exactly the same, even if the scale is almost incomprehensibly larger. When a company needs capital to grow, to hire more employees, to build new facilities, to develop new products, to enter new markets, it has a few options. It can borrow money from a bank, taking on debt it must repay with interest, or it can invite the public to become co-owners of the business by issuing shares of stock. When a company does this for the first time, it is called an initial public offering, or IPO. The company works with financial institutions to determine how many shares to create and what each one should be worth. Those shares are then offered to the public, and suddenly, ordinary people, anyone from a retiree in Florida to a software engineer in Toronto, can own a small piece of a real business. But what does owning a share actually mean? Think of it this way. Imagine a pizza shop that is doing incredibly well. The owner wants to open 20 more locations, but he does not have enough money to do it himself. So he divides the business into 1,000 equal slices, not slices of pizza, but slices of ownership. He sells 800 of those slices to investors, keeping 200 for himself.
Each investor who buys a slice now owns a proportional stake in the entire business. If the pizza empire grows and becomes wildly profitable, the value of each ownership slice grows too. Investors might also receive regular payments called dividends, which are a share of the profits distributed to owners. And if the business struggles or fails, the value of those slices declines. This is the elegant, almost deceptively simple heart of the stock market. It is a mechanism that allows businesses to access the capital they need to grow while giving ordinary people the opportunity to participate in that growth and, ideally, build wealth over time. Now let's explore how supply, demand, and human psychology determine the price of a stock. Here is where things get genuinely fascinating. Once shares exist and people can trade them with each other, their price begins to move. And understanding why prices move is where psychology enters the story in a very big way. At its most mechanical level, stock prices are governed by supply and demand. If more people want to buy a particular stock than want to sell it, the price goes up. If more people want to sell than want to buy, the price goes down. Simple enough. But here's the question that really matters. What makes people decide they want to buy or sell in the first place? This is where the logic of markets collides head-on with the reality of human nature. In theory, investors are supposed to be rational actors. They should carefully analyze a company's financial statements, evaluate its competitive position, estimate its future earnings, and arrive at a fair value for each share. In reality, markets are crowded with human beings who are driven by the same emotional forces that govern every other area of their lives. Consider what happens when a well-known company announces that its quarterly earnings exceeded expectations. Rationally, this means the business performed slightly better than analysts predicted over a 3-month period. Emotionally, it triggers a wave of optimism. Investors who were on the fence about buying suddenly feel confident. People who already own shares feel validated. The feeling spreads. More buyers enter the market. The price rises, sometimes far beyond what the actual earnings increase would logically justify. This is not rational behavior. It is a confidence cascade, a mood moving through a marketplace.
Now imagine the opposite. A major company announces a product recall, or a scandal breaks involving its leadership, or a respected analyst publishes a report questioning its future prospects. Rational investors might weigh this new information carefully and make measured adjustments. But markets are not made of rational investors alone. They are made of human beings who feel fear. And fear, in financial markets, is contagious in a way that very few other emotions are. Sellers rush to exit before things get worse. Their selling drives the price lower, which triggers more fear in other investors, which triggers more selling. What began as one piece of bad news can spiral into a cascade of panic that sends a stock price plummeting far below what the underlying business actually deserves. This phenomenon is so well documented and so consistent across market history that behavioral economists have given it a name: herding behavior. We follow the crowd, not because the crowd is always right, but because following the crowd feels psychologically safe. Now let's uncover the powerful forces that move markets beyond just the numbers on a balance sheet. Beyond raw emotion, there is a rich ecosystem of forces that shape how investors perceive a company, and therefore how much they are willing to pay for its shares. Think about the role of news. When a pharmaceutical company announces that a drug it has been developing for a decade just passed a major clinical trial, investors do not just see the news, they see a story, a narrative about the future. They imagine the revenues that drug could generate, the lives it could change, the competitive advantage it gives the company. They begin buying shares not based on what the company is worth today, but based on what they believe it could be worth tomorrow. Stock prices, in this sense, are not measurements of current reality. They are collective bets on the future. They are the market's best guess, aggregated across millions of opinions about what a business will become. Technology plays an enormous role in these shifts. When the personal computer emerged, when the internet went mainstream, when smartphones became ubiquitous, the companies at the center of those transformations saw their valuations multiply in ways that seemed almost surreal. Investors were not just buying earnings, they were buying a possibility. They were paying for the chance to be part of something that might reshape the world. And sometimes they were right, and sometimes the possibility turned out to be far more modest than the enthusiasm suggested, leading to sharp corrections when reality caught up with expectation. Leadership matters too, in ways that are deeply psychological. When a charismatic, visionary chief executive takes the helm of a struggling company, investors often respond with enthusiasm before the new leader has done a single thing. The market is not reacting to results, it is reacting to belief that this person has the ability to turn things around. Conversely, when a trusted leader unexpectedly resigns, the price of a stock can fall sharply in a single afternoon, even if nothing about the underlying business has changed in that moment. We are investing in stories and in people just as much as we are investing in financial metrics. And then there's the broader economic environment. Interest rates, inflation, employment figures, geopolitical events, all of these factors shape the backdrop against which companies operate and against which investors form their expectations. When the overall economy is growing and people feel prosperous and confident, money flows into markets. When recession looms or uncertainty rises, money retreats towards safety. Markets breathe in and out with the psychological state of society as a whole. Now let's dive into the unpredictability of markets and why patience can be the most powerful strategy of all. Here is one of the most important and most counterintuitive insights in all of finance. Despite all the technology, all the data, all the incredibly sophisticated analytical tools available today, nobody consistently predicts what the stock market will do in the short term. Not professional traders, not investment banks with thousands of analysts, not hedge funds with supercomputers running algorithms around the clock. The short-term movements of markets for most participants most of the time are simply not predictable with any reliable accuracy.
This is not a controversial opinion. It is backed by decades of academic research. Study after study has shown that the majority of actively managed investment funds run by professional investors who get paid handsomely to pick winning stocks, fail to outperform a simple index fund that just holds a broad basket of stocks over time. The market, as a collective intelligence of millions of buyers and sellers, is extraordinarily efficient at incorporating all available information into current prices. Trying to consistently outsmart that collective is an enormous challenge, even for the best minds in finance. This is precisely why so many financial educators and long-term investors advocate for a different approach. Instead of trying to predict which stocks will rise or fall in the next week or month, the focus shifts to participating in the long-term growth of the economy over years and decades. Historically, the broad stock market has trended upward over long time horizons, despite experiencing crashes, recessions, and periods of extreme volatility along the way. An investor who stayed the course through these storms and did not let fear or greed drive impulsive decisions has generally been rewarded over time. This is where financial psychology becomes absolutely crucial, because the greatest enemy of long-term investing is not market volatility. It is the investor's own emotional response to that volatility. The urge to sell when prices fall, the urge to chase rapidly rising stocks out of fear of missing out, the tendency to check our portfolios obsessively and make decisions based on the anxiety of the moment rather than the logic of the long term. Managing these impulses, developing what some researchers call emotional discipline around money, may be more valuable than any trading strategy ever developed. Now, let's explore how the stock market has opened up for everyone and where you fit into this remarkable financial landscape. Here is something genuinely remarkable about the world we live in today. For most of human financial history, the stock market was the exclusive domain of the wealthy. Participating in the growth of great companies required significant capital, access to brokers, and a level of financial sophistication that was simply out of reach for most ordinary families. That world has changed in ways that would be almost unrecognizable to investors of a generation ago. Today, anyone with a smartphone and as little as a few dollars can open a brokerage account, buy fractional shares of major companies, and begin participating in markets that once required a wealthy family and a relationship with a Wall Street firm. The tools for financial education, videos, podcasts, books, courses are more accessible and abundant than ever before. The barriers that once kept ordinary people out of the investing landscape have been dramatically lowered. This democratization of finance is extraordinary, but it also comes with a responsibility. Access to markets without understanding how they work, without appreciating the psychological forces that can drive impulsive decisions, can be as dangerous as it is empowering. The person who downloads a trading app and makes decisions based on social media hype is not investing. They are gambling, often without realizing it. Financial literacy is not just an intellectual luxury. In a world where markets are accessible to everyone, it is an essential life skill.
And that is exactly why conversations like this one matter. Understanding that the stock market is not a machine, but a mirror, a reflection of collective human psychology, confidence, fear, ambition, and belief changes how you engage with it. It moves you from the emotional, reactive crowd to a more thoughtful, informed position. It gives you a framework, not just for making investment decisions, but for understanding why you react to financial news the way you do, and how to separate the signal of genuine opportunity from the noise of short-term emotion. The stock market, at its core, is one of humanity's most fascinating social experiments. It is a place where the future is being priced in real time by millions of human minds, each of them bringing their own hopes, fears, knowledge, and blind spots to the table. Learning to navigate it well is less about finding the perfect stock and more about understanding yourself, your relationship with risk, your time horizon, your emotional triggers, and your deepest beliefs about money and what it means for your life. That is the heart of financial psychology, and we are just getting started. Now, before you go, we want to hear from you, because this community is built on your questions and your insights as much as our own. Have you ever invested in the stock market? What was that experience like, and what emotions came up for you? Do you think markets are driven more by logic and data, or more by human emotion and psychology? We would genuinely love to know what you think. Drop your answer in the comments below. It usually sparks some of the best conversations on this channel. And here's a question to carry with you. Of all the psychological forces we talked about today, fear, greed, confidence, herding behavior, narrative thinking, which one do you think has the most power over financial markets? There is no single right answer, and the debate is one worth having.
If this perspective on the stock market challenged the way you think or gave you a deeper understanding of how money and psychology really interact, then don't just move on. Take a second to engage with it. Hit that like button so more people can discover this kind of insight, and so the algorithm knows this message matters. Share this video with someone who is trying to understand investing. You might completely change how they approach money. And if you want more content that helps you think smarter about wealth, subscribe and turn on notifications so you never miss what's coming next. I'd really love to hear your perspective. Drop your thoughts in the comments below. Wishing you clarity, confidence, and smarter decisions on your financial journey. And I'll see you in the next video.